Let's check in on the price of oil. It sparked higher after we saw geopolitical tensions in Yemen. It's actually fading a little bit. It's still up on the day, but not up as much as it was. We're going to talk technicals with Todd Sohn, ETF and technical strategist at Strategas Research Partners. And Todd, here we can just cancel out the noise of the fundamentals and just look at patterns and behavior. I mentioned that it doesn't look like that oil rally is holding right now, at least not as emphatically. And I guess, do you see that kind of reflected in the energy stocks as well?
Yeah, hi, Amber. Great to be with you. Absolutely. Oil and the underlying energy equities have been horrendously inconsistent for well over a year now. And keep in mind that energy from 2020 to 2022 went through a major historic momentum surge. And I think that was being worked off for much of last year. But now you're having these geopolitical underpinnings and oil's struggling to really get itself out of the way, right? You're stuck between 70 and 90 bucks. Until then, to me, it's very much a chop central, and a lot of opportunity cost comes along with that, especially as you have other parts of the market accelerating higher. That's the big issue for energy right now. Keep in mind the opportunity cost.
So one part of energy, though, that has broken out is those uranium stocks and hitting fresh all-time highs with Cameco and NextGen as well. On a fundamental basis, the valuations look high, but when you're looking at it on a technical basis, how did the charts look?
Yeah, I mean, amazing is number one. Momentum is always hard to stand in front of, right? We have a freight train going through here in terms of the uranium names. Now, keep in mind, though, you look at URA, you look at Cameco, they're starting to get very, very extended from their 200-day moving average, right? Just a simple measure of trend. And so if you are long those names, you stay involved, but you have to make sure you have the plan on when mean reversion strikes, because that can be painful and you can get a serious drawdown. So listen, they provide the leadership. They're the best charts in the energy sector and part of the broader market too. But just keep in mind the threat of mean reversions, let's say out of uranium and back into, say, maybe E&P type energy names, does exist as the year goes along. So I do want to just keep that in mind. But for now, you stay with the trend. You stay with the powerful momentum for uranium.
And today was a big day for earnings in the U.S. for those U.S. banks. The Canadian banks certainly had a nice run from their lows in October. How meaningful was that sort of trend reversion?
Huge, right? The TSX, totally inconsistent in 2023. That's because energy stalled out and the banks were mired in a steep correction. I think we might be out of the woods finally for some of the big cap bellwethers, and that's going to be the catalyst. Assuming they pause and pull back here after a nice run, that's going to be the catalyst to get the TSX up and out of this range. And if you're just looking for timely areas, right, there's the banks and financials. But if you're looking for timely geographic regions, Canada's right there, right? The U.S. has had a good run, starting to actually hit new all-time highs. Japan has had a good run. Some of the European indices have a good one. But let's not forget about the TSX. It's one of the more timely indices out there. And if the most important group is going to start working and re-accelerating, that being the banks, then that is the major tailwind we want to see. It's not just going to be Shopify or Cameco like we were just talking about. You want those banks involved. And I think they're finally starting to get their act together after a meaningful correction over the last, call it, year and a half or so. The bar is really low for continued improvement from them.
And which banks in particular?
I think you look at the big bells, right? You look at Royal, BMO, and TD. That's the ones I'd stick with. Stick with big and large right there. There's a couple down the cap scale that still haven't quite improved on their trend front. But in terms of our work, the big bellwethers are the ones where you're starting to see major reversals. They had pretty extreme, almost, I have to use the word, puking mechanisms late in the fourth quarter there. And that's almost the type of action you want to see, this purging late into the end of the year and these big reversals. That's part of the process of putting in a bottom and seeing a total reversal from a major corrective environment to something that's going to be more durable of an uptrend going forward.
As a technical analyst, are you watching this Magnificent Seven index that has been constructed because it is kind of a random group of tech companies, and we've started to see a bit of split performance, Tesla lagging, NVIDIA surging. How are you thinking about the momentum of them as a group and maybe some of those individual names?
Yeah, there is some splintering going on. The important relationship I'm watching is the Magnificent Seven ETF, MAGS, relative to the reverse weighted S&P 500. That's YPS, right? So you're looking at the biggest of the big names in the index versus the smallest type names, right? More of an equal weighted basis. And that, depending on which way it breaks here over the coming weeks, is going to tell us where we should skew our portfolios to an equal weight type skew there, or staying with these big names. Now, in terms of the splintering, NVIDIA, Microsoft, and Google all still have momentum and are breaking out. Keep in mind, though, they could get too stretched here, right? Mean reversion comes into play. But you have names like a Tesla, which is frankly indifferent here. Apple, a pinch softer too, and giving up on its relative profile. So maybe this group won't be what it was for the last year. And now you're entering a different phase where earnings are going to start to matter more for each of these types of stocks. And selection may be even more important than it's ever been, especially for this group that has become attached at the hip to each other.
All right, Todd.